When you look at your savings account balance or your monthly paycheck, you believe you're dealing with a fixed measure of value. You trust that the currency you earn today will buy roughly the same amount of goods tomorrow. This belief is the fundamental illusion upon which the entire modern financial system rests. You are being robbed. Not through a traditional tax hike, not through outright theft, but through an invisible, calculated system designed to transfer your hard-earned wealth without your consent. They call it inflation, but history reveals its true name, the silent tax. Inflation is not a mysterious economic weather pattern, nor is it merely a side effect of supply chain disruptions. It is deliberate policy, a tool perfected by governments and central banks over 2 millennia to achieve one brutal goal: to liquidate their colossal debts by destroying the value of your money. This systematic erosion of purchasing power is the structural backbone of modern financial repression, and its true mechanism is laid bare by an ancient law of money known as the Cantillon Effect. Once you understand this law, you will never look at your savings, your rent, or the stock market the same way again. You will see clearly why the game is rigged and how your effort is quietly transferred to the hands of the elite.
Every empire that grew rich enough to sustain massive, perpetual deficits eventually faced the same impossible arithmetic. The costs of endless wars, bloated bureaucracies, and unsustainable promises always outpaced real production. The choice became agonizing: raise taxes openly, political suicide, or cheat secretly. The Roman precedent: debasement as tax. Ancient Rome mastered this stealth theft. Its strength was long anchored by the silver denarius, a coin trusted across the known world due to its high purity. But as wars and overspending drained the treasury, later emperors resorted to the oldest trick in the book: debasement. Starting with Nero in 64 AD, they reduced the silver content of the denarius, mixing it with cheap copper. A coin that was nearly 95% pure silver under Augustus plummeted to less than 5% by the 3rd century. The state essentially turned itself into a counterfeiter, imposing a silent tax that paid the legions with cheaper coins while secretly robbing every citizen's savings. The face value remained the same, but the purchasing power evaporated. The modern echo: fiat and the Nixon shock. Today, we don't chip silver from coins, we print digital trillions with a keystroke. The method changed, but the moral arithmetic remains identical. The great turning point came in 1971. President Richard Nixon severed the last link between the US dollar and gold, ending the Bretton Woods system. From that day forward, the dollar and every major world currency became pure fiat, backed by nothing but faith and government promise. This decision gave central banks the unlimited, unchecked power to create money at will to fund gargantuan debt, a process known today as quantitative easing. The consequence has been slow-motion, engineered decay. Since 1971, the US dollar has lost over 85% of its purchasing power. This didn't happen overnight like a sudden tax bill. It happened gradually, year after year, through the targeted policy of inflation. The mandate of perpetual loss. Modern central banks openly target a steady low level of inflation, typically around 2% per year. This is presented as a sign of a healthy, growing economy. It is, in fact, a promise of perpetual loss. A 2% inflation rate guarantees that the money you save today will lose nearly half of its real purchasing power in just over 30 years. Why institutionalize this loss? Because inflation is the government's escape route from its impossible debt burden. By ensuring the currency declines in value, governments can repay their immense debts, $34 trillion in the US alone, with cheaper, diluted money. The diligent saver is punished for prudence, the reckless borrower, the state, is rewarded. Your savings are the collateral, and your future is their funding source.
The inflation tax is already insidious, but the way it operates makes it a perfect mechanism for wealth transfer, ensuring that the middle and working classes bear the full cost while the financial elite reap the benefits. This process is known as the Cantillon Effect, named after the 18th century economist Richard Cantillon. The flow of new money. When a central bank creates trillions of dollars, that money does not instantly appear in everyone's bank account or scattered equally across the market. It is injected into the economy at the very top, flowing first to those closest to the money source, the government itself, major commercial banks, investment funds, and asset owners. These first receivers benefit immensely. They get to spend the newly created money when its value is still relatively high, before that money has inflated the price of goods and services. They use this cheap, freshly minted credit to acquire real assets, stocks, bonds, luxury goods, and prime real estate. This injection of new liquidity instantly inflates asset prices, creating the enormous wealth gap we observe today. The pain of the last receiver. The Cantillon effect dictates that by the time that newly created money trickles down to the last receivers, the ordinary worker receiving a slight wage increase, the pensioner relying on fixed income, or the small business owner, the prices of essentials have already soared. The middle class faces a cruel double blow. 1. Asset inflation. The price of buying a house, the key to middle-class stability, has multiplied tenfold because the rich use the initial burst of cheap money to buy up those assets. 2. Cost of living inflation. The cost of groceries, fuel, and rent rises sharply as the diluted money finally reaches the consumer economy. In short, the elite receives the wealth transfer through asset appreciation, while the masses receive the inflation through soaring living costs. They are kept running on a financial hamster wheel, where their effort is constantly eroded by the invisible decay of the money they earn. This is the purest form of wealth extraction.
The Cantillon effect is not a market anomaly. It is the structural foundation of financial repression. This strategy is essential for keeping the debt-based system functioning, and it is built on punishing prudence. The illusion of the low-rate trap. Central banks maintain interest rates at artificially low levels, often below the actual rate of inflation, resulting in negative real interest rates. If you save money in a safe bank account, you are guaranteed to lose purchasing power every year. This is not a mistake. It is a feature designed to force capital out of cash and into riskier assets like the stock market or real estate. The state needs you to participate in these risky markets because rising asset prices create a wealth effect. People feel richer, so they spend more. And it helps prop up the collateral underlying the entire debt system. Saving is penalized. Speculation is rewarded. The irony of debt. In this repressed financial order, debt is no longer a burden. It is the most profitable product in history and the bloodstream of the economy. The system needs more debt to grow. If borrowing stops, the economy contracts and central banks panic. This ensures the wealthy benefit immensely because they can borrow at the artificially low rates. The Cantillon flow is cheap credit to acquire appreciating assets. The ordinary family, meanwhile, acquires high-interest debt, mortgages, student loans, credit cards, at the inflated tail end of the money flow. The system rewards leverage, not labor. The psychological weapon. Financial repression is effective because it is psychologically confusing. Inflation creeps in slowly. It doesn't look like theft. The average person blames their employer for stagnant wages or the local grocer for high prices, never realizing the fault lies in the systemic, constant dilution of the currency unit itself. By keeping the public uneducated in finance, by presenting inflation as a complexity rather than a policy, the wealth transfer can proceed unnoticed. The system depends on compliance, ignorance, and the public's continued belief that the game is fair.
History teaches that this balance between deceit and disaster never lasts forever. The Cantillon effect and financial repression create extreme tension. Once the middle class realizes the game is rigged, trust breaks, and the rush to exit paper money accelerates. The breakdown of trust. When confidence breaks,
The currency dies. History provides brutal case studies. Weimar Germany, 1923. Hyperinflation wiped out the middle class overnight. Families burned banknotes for heat because coal was cheaper. People only survived by holding on to anything real: gold, silver, foreign coins, food, or functional assets. Rome, 3rd century. When the denarius became copper discs, trade collapsed and loyalty vanished. Merchants refused the worthless coins, demanding payment in real goods, food, or land. Modern echoes. Even today, in struggling economies like Argentina, locals price real estate in US dollars because they understand that paper, backed by politics, always fails. The pivot to real value. The families who survived every collapse, from Rome's debasement to Zimbabwe's trillions, followed one simple, timeless rule: real wealth is not paper. Financial freedom in a system designed for theft requires shifting strategy. It means stepping sideways, outside the reach of the money printer. What survives the Cantillon transfer and the silent tax? Productive assets. Land that grows food, productive businesses that generate cash flow, and tools that create real value. These cannot be printed or inflated away. Skills and resilience. Skills that are in perpetual demand: coding, construction, problem solving, which represent value that cannot be devalued by a central bank keystroke. Scarce stores of value. Gold, which has proven for millennia to be the one anchor that doesn't require belief, and other assets like Bitcoin, designed with fixed scarcity to counter fiat's endless expansion. The system counts on your ignorance. It fears your awareness. The silent tax, the Cantillon Effect, and financial repression are mechanisms to keep you running on the financial hamster wheel while the elite extracts the value you create. Once you recognize the pattern, that your currency is designed to decline, you stop being the victim and start positioning yourself among those who understand the mathematics of collapse. History doesn't repeat, but the process of financial theft, from Rome's copper coins to modern digital trillions, always rhymes. The difference today is simply whether you hear the warning in time.